Hey, how's everyone doing? Just want to jump on and address a few of the questions that I got specifically from my last post. So the first one was, what's better, short term or long term? So that question should actually be posed as, what would be better, term insurance or whole life? The difference between those two is that term insurance is only good for a certain term period, say 5, 10, 15, 20 to 30 years. Once that term length is up, the policy stays in effect, but your price will skyrocket. It will jump through the roof 3 to 4 times what you were paying during that term period. So short term, no pun intended, term insurance will be less expensive. Now, whole life is exactly what it's called. It is with you for the whole of your life. As long as you're making your monthly payments, it won't go away. It stays with you until you die and need to use it for your family. So that will be a little more expensive on the monthly payment side. One of the benefits of whole life is that it has other living benefits that are available usually, depending on the rider, which is a special extra that you can have right along on the whole life policy if you wanted to. For example, accidental death. That is a very common, popular rider, which means you will get paid out additional funds if you were to die due to an accident, whether it be auto, something happened at the house, anything that's basically outside of a health-related death. You would get extra money to the beneficiary if that were to happen. And usually those are very, very, very low cost compared to the monthly payment of the policy itself. That's just one example of what we would call a living benefit for whole life. And that's part of the reasons why it is slightly more expensive. Another perk is that as the policy builds up cash value over the years, you do have the opportunity to withdraw money out of the policy as a loan to use towards a car, towards a house, whatever it might be, debt consolidation. Then you pay your policy back that money that you're borrowing from it at a fairly low interest rate. But again, you're borrowing your own money, you're paying yourself back. It doesn't affect the policy. The only thing that it could do is that if you were to pass away before you paid that loan back, that loan has to be paid out of the benefit, death benefit, to whoever's getting it. So let's say you borrowed $10,000, you paid back half of that, you were to accidentally pass away, the remaining $5,000 of that loan would have to get paid back, and then the remaining balance of the benefit is paid to your beneficiary. So those are the key differences between whole and term. I don't have a preference. I'm not going to push you to one or the other. I'm going to recommend which one makes more sense for you and what you're trying to achieve financially in the future for your family and now based on your budget. I can find out pricing off two factors. First one, I can find out what I can get you based on how much you want to spend per month. Second, I can find out what you're going to pay per month based on how much you want to get. Let's say you want $1 million worth of coverage. Fine. I can look that up through the different companies I'm partnered with and tell you what some of those companies are going to charge you on a monthly basis for that much coverage. Or you just want to spend $100. That's your goal. No problem. I will see what the max benefit I can get you for $100 a month. Okay? Again, if you have any questions, reach out to me, send me a DM, post a comment on this post. You can text me at 331-210-4786, or you can email me at Coach Jerry, that's Jerry with a Y, at jdjfc.com. Okay? Appreciate you guys listening.